Hmm. Good afternoon, folks. How are you? If you all are hearing me, just give me a heads up on X. Just give me about a few 5x5s. Let me know you can hear me. And after that, we'll start this rave. Uh, Again, I'm waiting for confirmation. Master friend, thank you. Just want to hear, or not hear, but rather read a few more just to confirm. Fuse, thank you. Is the volume okay? Because it's not going to get any louder than this. Mm. Thank you, MD. El Gordo, thank you. All right, so it looks like you guys can hear me. That's good. All right, well, thank you for your patience. I appreciate it because typical of the female type of my brood, my wife and my daughter, they tend to do things unexpectedly. I guess that's a woman thing. But my daughter showed up unannounced, so that delayed me. I'm happy to see her, but my wife just took her out of here. So they went to a wedding that I don't go to them. I don't go to funerals. I don't go to weddings. Okay. And I really didn't want to go to my own son's wedding because I just don't like to dress up, but you have to do it, right? Anyway, hope you're all doing well. Welcome back. It's going to be a casual, just a real relaxed presentation today. I'm not going to try to go overboard. I don't have the energy level to do, my typical Saturday, what we call them, shotgun Saturday type thing. I don't have that kind of energy today. So I'll cover a couple things in price action, and then I got a tweet sent to me asking if I would cover how to use the open and close to determine the next draw on liquidity. That's a pretty good topic. I can pretty much nail that today in a very short period of time. So I'm going to try to complete this by 2:30 Eastern time. So it gives me about an hour or so thereabouts, and because I have some things I want to take care of on my own personal time. So I know I usually tease you and say I don't have a whole lot of time. And I go for a long, long time. Today, honestly, I don't have that kind of time. So I'm taking advantage of the fact that the ladies are not in my house today, so I get to do things. You know, I'm off the leash for a little while, so I want to take advantage of that. So the dollar index. Okay, we're going to cover that first. Left hand side, obviously, we like to look at it on the daily chart over there, and then the 5-minute chart is on the right. And I'll get over to the lower time frame in a moment. But I want to spend a few moments on this higher time frame chart. Okay, and we were looking at how price made its way up into this old buy side imbalance, sell side inefficiency. And as I mentioned before, I didn't want to annotate it as an inversion fair value gap. I wanted to wait to see how it behaved up there. And you can go back and look at the other recordings I mentioned about that. So I kept this color and this hue to kind of like remind you. I want to see, does it have the wherewithal, the conviction, the moxie, whatever it is that you want to call it, the strength, the buying pressure, right? Whatever that is in your mind collectively, to establish a continuation on the upside. It went to the upper end of it, pierced it by a little bit, spent a couple days inside of it, and then gave up the ghost and went lower. I mentioned that if we went lower than consequent encroachment and dug in below this low, that we would probably want to see higher prices or another challenge to the all-time highs of NASDAQ. Okay, so I was kind of like blending two markets using um, intermarket analysis concepts. So that way we're using dollar based ideas, risk on, risk off. And if you don't know what that means, when the dollar index is rallying higher, that's a risk off scenario. When it's dropping, that's a risk on scenario. And how that's translated into using index trading, we're live. So you're going to hear all that stuff in the background. I can't do anything about it. They're my pets and they get to say whatever they want to say. And when the dollar index is going lower, that gives a green light for index futures, forex pairs that are dollar based to rally higher. So in other words, it's not a guarantee. In other words, it's not a panacea where just because the dollar index is dropping, therefore the S&P and the Nasdaq and the Dow and the Russell, and all those indices should go straight up because the dollar index is dipping or dropping lower. It just means that if you do get very strong technicals that indicate high probability long in those markets, and I'll kind of classify that today when we get to Nasdaq. Everything I'm going to tell you today is applicable to all markets. So if you're trading forex, if you're trading commodities, if you're trading stocks, if you're trading, um, I don't want to say crypto because I don't know anything about crypto, and I love the idea that people ask me all the time, and I tell them I don't know. Okay, I don't know, and I have no faith in it, so I can't co-sign for that one. But bonds and obviously, when we're looking at the dollar index, it's a barometer. We don't trade the dollar index, but we use it to indicate whether or not there's some underlying bullish or bearish tone that's underneath. Okay, it's some kind of under the surface credibility that we can establish behind when the market's on a risk on, risk off basis relative to the direction that the dollar's moving. And again, if you missed it, dollar rallying higher, going up, is risk off. That means everything else, if you have a sell signal that's high probability, you're probably looking at something that's going to work out. Not a guarantee, but it really qualifies a high probability condition for a short. Now, if the dollar index is dropping, okay, as we left this area up in here, I mentioned to you before it did this, I said if it were to trade back down and go below that low, then we're probably going to make another attempt to go higher in the Nasdaq. Whether it relates to getting all the way back up to all-time highs, remains to be seen because it did a huge drop 2 Fridays ago. So you have to kind of like balance all that stuff out. But as you can see, the dollar index made its way lower than that low and worked outside of this suspension block into this candlestick's wick and all the way down to consequent encouragement of this old inversion fair value gap. You can see how the nice reaction off of that came right back up, and we just fell short of reaching the low of the suspension block right in here. Okay, so what I want to do is I want to show you when we're looking at, because I'm getting this question a lot. I'm getting it both in responses to me when I post something on X, and I'm getting bum rushed all the time with this one question, regardless of whatever the topic is I'm replying to. This one keeps being forced on me, and it's happening a lot in the comment section of the video. So that's how you get it. That's how you get my attention. By the way, I'm not offended by that kind of stuff, but I have a lot of people sending me stuff all the time, and while I believe I'm seeing everything as it comes to me or I catch up to it, sometimes like today I didn't get a chance to see it much. So if you post to me and it seems like I'm ignoring you or I haven't replied to you, whatever, it's not personal unless you've said something in the past and offended me, and then I'm more or less muted you. So chances are that might have been the case for you, but most times it's not. It's just simply I can't reply to everyone. But the question is coming up that how can we determine where the market's going to draw to next, and what are we doing with these wicks? Why do I pick this one wick over another? And I kind of like want to drill that home today, so that way it'll help you, because I do talk about it in the books. But again, just to let you know, I'm teaching visually over price action. Everything I'm going to talk about in the books, I've talked about here, but I'm going to give you rule based ideas that are very succinct. They're just this, and this is all I'm worried about. Okay. So if you've been very diligent about taking notes about what it is I teach here, you don't need to buy my books. Okay. You don't need, it's not a cash grab. I don't give a shit if you buy my book or not. I don't care. Okay. It's just me putting it in form of written. So that way, everything that I've ever said about my own work is now in print. I said it, and then everybody then can copy it correctly, not go out and try to make books and write things that they don't even know half what they're talking about. So when I'm looking at price action, okay, if you're not going to pay attention to this kind of discussion, if it doesn't interest you, if you don't like going into the details, I promise you everything that you study under me will frustrate you. It's not meant to be easy because it's very technical. But what I'm going to explain to you here is very generic approach to every single time I'm looking at price action. My mind frames out a specific area in price action. See, when you look at this chart, you're looking at all of these candlesticks and you're looking back. You're like, okay, where's there a fair value gap in here? Where's there relative equal highs? Where's there a wick over here? I'm not doing that. I'm not doing that at all. That's not what I'm doing. So what I'm doing is I want to see, okay, first if the data range is 20 days look back. Okay. So what would that look like? What would that constitute as a beginning and ending point? So that way you have a very easy framework to start and hit the ground running this week. That way you can go and start using this information yourself. We're on Saturday. Okay. It's October 18th, 2025. It's a Saturday. The markets are not trading unless you're a crypto freak, and I'm not trading crypto, so I could care less. So this is looking at the close on Friday. Okay. Count that day as one. One, two, three, four, five, six, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. So right here, September 22nd, that's 20 days look back. Now, inside that range of 20 days, what we're going to look at is the highest high and the lowest low. Very, very simple. It's not complicated. It's not ambiguous. It's very specific. So what would that be? This is the lowest low, and this is the highest high. So in deference to those two price points, there's the 22nd, and the candle right before it's the lowest one. In all of these ranges up to that high, this is the lowest one. So all you're gonna do is drop a box on that, anchored up there, and this is just for visual representation. You don't need to do this because it's just lipstick to help me communicate something to everyone that's watching. But inside this range, that is my 20-day look back. That's all I ever need. I don't ever need to look to 40 days or 60 days. Now, if you're in a market that's running, for instance, like gold, and we'll talk about gold in a little while. But if we're looking at just tell me what the market needs to be focused on right now, what PD arrays are going to work right now, which one's the central focus, what draw on liquidity is the ones that I need to be worrying about right now. Give me the right now skinny ICT. Make it short and sweet. I ain't got time. I'm only 20 years old. I ain't got this all the time in the world to learn all this stuff. Okay. This is what I'm looking for right here. This is my bread and butter when I'm real quick, kind of like sitting on the sidelines, waiting for something to pop up. My go-to is this. So I want to go back over the last 20 days. If it's a market like gold, I almost went over this without saying it. If it's a running trending market like gold is, okay, or silver, something like those markets where they're going parabolic, then I'll go back 60 or 40 days and I'll get the range there. Okay. And what I do is I want to see where are we in relationship to that range. Now, obviously, right now we're in the premium side because we went down to discount below. Here's this dark line here. That's 50% of that line. And you get that by having this middle line toggled on the rectangle tool. I don't mean to bore you, but I get a ton of questions. So I kind of like want to take these moments to put that kind of stuff in there because hopefully it'll reduce the number of questions I get that are repeated or redundant or seeming very elementary. And some of you guys get really offended when other people ask questions like that, on X. And it's almost like you're creating an atmosphere where no one wants to ask a question, which that pisses me off when I see that. So remember, you didn't know this shit the first time you sat down either. So at this line or above it is premium, or at this line below it is discount. Okay. So having all these reference points inside this range available to me, I first start fresh by looking at where are we in the range of that segment of price action. And I'm gonna okay, I'm just gonna plot it over top of this. It's already got a lot of stuff on it now, but just bear with me, okay? And everything will be in a black, bold line. It's gonna represent the grading of that 20-day look back. And again, this is for everything that I ever would ever want to trade. If it's Forex, if it's stocks, if it's commodities, bonds, index futures, whatever. Okay, whatever I'm doing analysis on, this is the very first thing ICT does. The very, 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 very first thing. Okay. Part of the things that I have written down, hear that? This is that little yellow notepad I tell you I always have. I have these levels when I'm looking at a particular market, or if someone prompts me, hey, look at this, the first thing I do is what I just did here. I grade the price swing or the range of the last 20 days. And then making sure that I have the full grading levels. By having this, it tells me where I can focus in on very high probability shifts in market structure, where it can draw down to as a retracement, and what PD arrays lie inside of each one of these quadrants. Because every one of these quadrants also can be graded. So that way you have a 20-day look back like this. So here's upper quadrant, like not the highest upper quadrant, but this one here, but it's in a premium. Then we have equilibrium, and in the lower, below the midpoint equilibrium, but not the lowest. So the extremes, when we get into these areas here, when we have a 20 look back that's bullish or has been moving higher like that, unless I'm expecting a complete reversal or basically a bear market resuming, I'm not looking for anything in this lower area down here. My focus is going to be primarily in this area here and this area right in here. All the setups, all the things you're going to look for that are many times just actionable PD arrays that you can just get in there and just take a trade on intraday. 15-second chart, 5-second chart, 1-minute chart, 5-minute chart, 15-minute chart. You're going to see all kinds of busyness available to you as a short-term high frequency trader. And forego the idea that it needs to get down this extreme lower quadrant. Okay. And I'll give you all the boring details about that, at another time, because if I did that here, it would fill the whole hour up. But this is what I'm doing. And I have these levels by price: 97.215, 97.802, 98.389, so forth. I have that written down on my little notepad. Okay. Now, inside of all these quadrants, there's going to be PD arrays. Okay. And those levels with their respected grading levels, I have those in order. So inside this little notepad, on whatever page I'm looking at, like right now, I have NASDAQ. This is the one I'm focused on primarily. If this were dollar on my pad, and I want to share everything that I want to give to you, is not everything on my pad, because I'm not hiding anything from you, but it's just I want to keep things personal. You know what I mean? And I don't feel comfortable sharing everything. Not You don't need to know every detail, but I am telling you what I'm writing down. But every PD array in here and its respective quadrants, like this wick in here, I would have that written down below this price level here, and it would all be listed from the highest to the lowest of what I'm looking at. And then I'm watching price. I only put things on my chart when I'm recording, if I'm doing a trade. All that stuff's being put on the chart so you can see it working. I don't look at that stuff when I'm watching price. I'm looking at price completely and utterly naked, and I'm watching just where price is at over here on this price axis, keeping track of time. That's how I'm trading. You think I'm looking for these boxes to be touched. I'm watching it visually. I don't need to see them painted over top of price action. In the beginning, you will probably use that as a useful tool or crutch. And I don't mean that to be derogatory. It just means that you may outgrow it. Don't feel that you have to. Don't feel like, well, ICT said this, so therefore I got to do that, or I'm not going to be a good SMC or ICT trader. Unless I can do it like him, then I'm not really equipped. That's not true. I'm just telling you, because of my necessity for keeping a chart clean, having nothing on the chart at all, it allows me to have the opportunity to see something fresh on the chart that otherwise might not be so obvious, because there's a lot of things already on this chart here, which is very busy for me. Like I don't ever have something like this on my chart. And this looks like stuff you see on TikTok or Facebook or everywhere. I don't have that kind of stuff on my chart. But as a teacher and showing you how it is I'm calling these moves before it happens and turning it on a dime and goes right to this tick and stop, I have to give you the visual tools to see what it is I'm pulling out of price action and what segment of price action I'm referring to. So don't be afraid to I guess, warm up the idea that you have to do well, use this level of annotation on your chart. If it's comfortable for you to do that, then by all means, there it is. But I personally want to give myself the ability to recognize when there's nothing on my chart. If there's a new PD array forming that I didn't notice it. And like I said, I have 53-year-old eyes and they're not as strong as they used to be. And sometimes I'll draw a box when I'm trying to show you all, and I may not see a volume imbalance because my eyesight's poorer than it was just 2 years ago. And it's not intentional. I'm not trying to cause confusion. It's just that's just a frailty at my age right now, and I'm in between eyeglass prescriptions, and I don't want to get them yet until the end of the month. So we're looking at this range here, and inside of this portion, okay, 75, 50 to upper 25%. That is where the heart or the core of most of everything you're going to see that's useful to you, it's going to reside inside that. So that way you can ignore this area for now until it comes all the way down to the lower quadrant and breaches on a closing basis. You need not concern yourself with anything down here. That's how I'm interpreting price action using a 20-day look back. So I'm focusing primarily on just this bit of business in here. Okay. So with that said, we're going to remove this now, and I'm going to remove this box and go back to what I had here. Okay. So now you know what that looked like. I'm not going to give you a PDF of this stuff. So the way you can do is watch the video, pause it, and then do a screenshot. Okay. And there's your equivalent to what I would be putting in a PDF. I don't have the time today to do that. I don't mean that to be curt to anyone, but everything that would be done in a PDF file, you can gather it from this video. Okay. So we were up here, and I told you if it went down to this level here, then it would offer the opportunity for NASDAQ to go higher. And when we're up in this level here, using that idea that showed you on the 20-day look back, it allows you to frame a very specific segment of price action. So your focus is narrowed to what is the most salient range of price action that the algorithm is going to refer to at the moment. 20 days look back. By grading that, you can see where the upper quadrant and the lower quadrant, in deference to the equilibrium price point, inside that little area, or maybe not necessarily a little area, it could be a broad, big area, but inside that smaller portion of the last 20 days look back in dollar, all of that is going to be the heart of what the market's going to utilize. And you need not concern yourself with anything beyond that. So do you see how right away we're already reducing the argument down, okay, and distilling the principle of focus when everyone outside of our community, they'll say, well, this stuff doesn't work. Um, it doesn't make money. You can't use it. It's not predictable. and there's too many of them, and there's a lot of them that fail in terms of fair value gaps or PD arrays. By limit your focus to the upper quadrant and the lower quadrant in the last 20 days, whether the market's moved higher or lower, you are now focusing in on where every single one of the high probability PD arrays are going to form. Do you see the advantage in knowing that now? Every single time you sit down in your charts, and what will be interesting for you is by you going back and back testing. How would you do that real quick before I go on further? Let's say that you were doing this, okay, and you look back. This was the 20-day look back range here, but you want to do another research approach to it. Well, just move further over to the back of the old price data and just pick any random day and start there. Say, okay, I want to do a case study here. Let's say I was looking at price action here and count that as day one and go back 20 days and frame it and grade the range from the highest and the lowest, and then see where you're at and look at the upper quadrant and lower quadrant. And you're going to see everything that's being used is inside those very specific ranges. So that's what the algorithm's doing. It's cycling through on a daily chart in that range, highest and lowest, because it's an algorithm. That means it has to go back to a very specific data point. If anyone that's ever studied computer programming, um, it, it would be beneficial, honestly, if most of you had that background, even if it was a simple basic language. Okay, um, just knowing that a computer program needs to have it needs to have data. It needs to have something to generate an output from, and that is simply a data or an array of data. So where would this algorithm or computer program get that information? Well, if you say you're a computer programmer and you were going to do payroll for a company, you're creating um, a program or computer program to generate a payroll um, report. Well, you have to be able to go through the time punched in, the time punched out for every employee for each day, and then calculate their hours of start to end, total hours worked, and then you do all of the necessary calculations for the state and local tax and the federal tax and any kind of deductions or whatnot. And then it spits out that report and says this is what the company paid this employee, and it would do it for every single employee. Well, how does it go to that information? By date and time. You see? So when you're looking at price algorithmically, that's why it's silly. I don't understand why everybody is so constipated about the idea of these markets being rigged, because you should be thankful that they are rigged. Because if they weren't rigged, I couldn't do this. Nobody could do it. Nobody could absolutely figure this out. I should have brought my other chair. This dining room chair is uncomfortable. By having the reference to time, we can look back 20 days, highest high and lowest low, and then frame where in that range the algorithm is going to focus on primarily to use specific data points. On a daily chart, every individual day and its open, high, low, and close is a specific data array. It's a reference point. Now, what do you think happens when the algorithm is looking when we're up here? It's going back through all of this range. And we knew that this area in here is essentially the upper and lower quadrant, not the lowest extreme quadrant and not the upper extreme quadrant. It's just the middle part. Okay. While it's up here, if it's going to go back through every individual candlestick, it can determine, like this candlestick here, this is a premium wick when price is right here. If it's going to reprice lower for the purposes of allowing other markets to go up and create a risk on environment and trade to a deeper discount on its individual daily range, it would not use this candlestick premium wick because it's already below it and it plans to go lower. It's generating more delivery to the downside. So it's going to ignore this candlestick wick. But what will it do with, for instance, this wick? This is a premium wick too. Let me move it over so you can see it. See that? So this candlestick's high is delivered with a small little wick. I want you on your own time, take that wick right there and project those quadrants all the way through and look at every small little time frame, see if there's any rhyme or reason to why price maybe abused any of that. Then the next one after this candlestick going to the left in the look back of 20 days, it's going to be up here and then looking. Oh, now look, this candlestick has a daily high, and then its close is way down here, and its open is down here, and its low is a tick or so below that. So you can see visually that there's a long wick on the top end, right? So the algorithm is going to take that entire range of that wick, and what's it going to do? It's going to grade it. With that idea in mind, all I did was shrink down the daily chart. The open, up, and high. You don't need to be able to, um, I guess, have the 20 and I'm sorry, 25 and 75 where they're at. If it's the high end or the low end, in other words, I'm just real obsessive about it. If it's a wick that goes up and it's a premium wick on that individual candlestick, I always take it from the close up to the high, regardless of wherever I'm using it in terms of a discount or a premium draw. I'm just real anal about that because I have to have these levels on my notepad the right way. And by having them written this way, where it has the 25, the 50, and the 75 here, by having it that way written on my chart, or not my chart, but on my piece of paper, I don't have to have it on my chart. I'm looking at it by its label, its little annotation written next to the price level here, like 93.306. I know automatically because of the orientation of 25, 50, and 75 is a premium wick. So I don't need to write that part down. You see how I'm saving myself shorthand? Uh, well, I'm saving myself longhand writing in notes with shorthand ideas by referencing that. Okay. So referencing specifically if the 25 is the higher quadrant or the lower quadrant is what I'm referring to. And if it's the higher, then it means it's a premium wick on that individual candlestick. And then projecting those quadrants forward, watch this chart over here. Okay, because these levels are going to end up populating over here, and you're going to see a whole lot of things that never were noticed before. See them over here. Now they're showing up over here. Now watch. The algorithm right up at this day, the rules what I told you is if it goes down below consequent encroachment and goes below this individual candlestick low, then Nasdaq's going to go higher and dollar will want to go trading lower. And then we'd have to worry about going into this inefficiency and worry about this wick here. Go back and watch recordings. Okay. Don't take my word for anything I'm saying because I could tell you anything. I could blow smoke up your ass. And most of you would think, wow, ICT said, this, that, and the other thing. So I don't have to do any of that stuff. I can just take what he said and that's all I'm gonna do. Just believe what he says. No, don't believe anything I'm saying. Go out there and test it and see it for yourself. Because when you see it in your own charts, you don't need to have to worry about wrestling the idea or defending me on social media for people outside our community. You just let them believe whatever they want to believe. But if it's up here and it trades below that, the algorithm is going to have all these levels immediately because it knows this old day had a high and the close was significantly lower below it. It's open what's below it, and then the low is here. So it knows the orientation. So it knows how to grab this candlestick's high and this candlestick's close. It's a very short little order of coding that's required just to get the idea of each individual time reference. And anybody that's looking at candlesticks that are not time based, you are literally wasting your time. No pun intended. Because you can't get this information by changing these things to range bars or whatever else nonsense out there. Okay. As soon as you start manipulating and changing the order of where these open, high, low, and close are forming, you are stripping the advantage from everything you're doing. And if you do make money, it's just chance and guess. And if that offends you, I don't give a fuck because that's exactly what it is. You can't come out here and tell us where it's going to stop on a dime. You can't tell us that, but I do. And I do it all the time. And I do it as a litmus test because I don't see anybody else doing that. And you need to warm up to the idea that these markets are using time and it's using it just like this. Knowing this candlestick had a higher premium wick, stripping it down to just the quadrants. The close, the high, in every quadrant that's equal quadrants, lower quadrant, equilibrium, upper quadrant and the high. That's the price levels that the algorithm is going to refer to. Don't believe me? You don't believe me? Look at the 5-minute chart. Listen, folks. Listen, because some of you already see it. Like, what the hell? Yes, yes, Virginia. There's a fucking algorithm. So we're looking at first the 98.499. Okay, 98.499. That's this level right here. Okay, I'm gonna try to squeeze this area there. Now we can see it. So here at Thursday, the 16th, that's this day right here. Okay, on the daily chart, left hand side. On the 16th, we were above it while we were inside that blue suspension block. It starts to trade down and leaves that blue shaded suspension block. And then here's the high of that wick over here. So it's encroaching on that wick high when we get down to 98.499. Right here, we hit it. We drop a little bit from it, come back up, fair value gap, fills that in, drops. Fair value gap, fills that in, drops. Where's it drop to? 98.402. That's just the upper quadrant of this wick. Trades down to it, creates your little classic bull flag. It works then, doesn't it? It drops down to this equilibrium at 98.306, and then has some kind of random reaction, like a rash, or hives. It starts to bubble up and goes right to some random level, the upper quadrant level, at 98.402. Right away, this should get your rocks off, because this is not pivot points. It's not supply and demand. It's not Elliott wave. It's not Wyckoff. It's nothing but mine. Mine, just mine. And I'm sharing this with you because I want you to do these things in your own chart. Because every single meaningful price run, don't take my word for this, every single meaningful, significant, valid price run, and there's always valid price runs occurring all day long, every time frame, they all originate off of this idea. Oh my. Oh my. I just right there leveled the playing field for so many of you. I've watched some goofball sent me an email, said that what I'm teaching right now is nonsense. And my old stuff had some value, but this stuff here is nonsense. This right here is the fucking market. This is the source code. Okay? You take this out of my work, and I'll have retail results. Now, does that kind of exemplify, put a little exclamation point on the importance of knowing this? It should, because this right here is the foundation. It's the spinal column that holds all of the efficiency in price runs using my PD arrays and the efficacy of how I use them and when I select them. Because if you strip this away, there's no rhyme and reason why I would use any other fair value gap or any other PD array, any other order block. There's no way for me to determine which one it's going to use. This is it. This is the thing. This is the sauce. This is the secret. This is the whole fucking shebang, baby. If you understand this, they can never, 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 not a fucking time in the fucking future can they ever hide it from you. They can never fucking hide it from you. Now, can they have some crazy manual intervention where they whipsaw back and forth? Sure, you might lose money on that. You might get stopped out. You might take a big loss. But they can't keep doing that. Every day can't be a fucking seek and destroy, up and down this destroy, because nobody will trade then. So if you ever have that happen and you're using my content and you see something just go out of nowhere, like, oh shit, this completely, just wrecked me for this trade. Turn your computer off, wait a day, come back, and everything will go right back the way it was. Now, doesn't that give you peace of mind? It should. So there's no excuse for anybody to lose their mind and completely FOMO, fear of missing out, fear of missing a move, being afraid that you're not going to catch the move, afraid that the algorithm's going to fucking change. I'm not changing shit. There's no need. There's no need. Price trades up to this in here, trades right to the order block that's laying right there. Let me make it a little bit bigger for you so you can see it. See that little up close candle right there has a volume imbalance in it? Trades right up into that. It's the open of that price. What's this opening price at? 98.408. The high of this candle comes in at 98.410. So there you go. Hits it. Why does it drop? Because it's an order block? No. It's because my order block is stacked over top of and laying right on that quadrant. What quadrant is this? This premium wick array, upper quadrant, right there. And it drops, stops dead on equilibrium, and then it stays inside no man's land. Whenever you see price hovering between quadrants, don't touch it. That's when you're going to get burned. That's when your fair value gap is going to not be so pristine, not so helpful. It'll be unruly, and price will trade outside of it and through it. We open lower, trade down to the lower quadrant, this one here at 98 point. Let me show you the price levels over here. 98.20. Oh, I'm sorry, 209 to say it that way. And then trades down to the old inversion fair value gap right here on the daily chart, left hand side. First, let me pause for a second, okay? I really want you to understand something because I already know that I'm picking up on the force right now, okay? The Jedi in me is picking up on the disturbance. I'm picking up on the fact that I have a lot of people in this audience that doesn't fucking deserve me teaching this to them, okay? And I want you to know something. These are the things that I did not want to ever share because it's too fucking perfect. It's too good. And a lot of you 20-year-olds are going to go out there and write books, and you're going to make up your own little fucking mentorships, and you're going to pretend that you found this. You discovered this, or some fucking dead person that never even used this information ever. Okay. Or some fucking horse shit that Chris Laurie teaches this bullshit. He doesn't fucking know anything about it. Maybe he's taking notes. Hi, Chris, if you're listening. But the bottom line is this doesn't exist anywhere else. It never has existed anywhere else. And I want you to just take a moment and just think if you knew this and you could do what you watch me do every time I come out here and tell you what the market's going to do, it does it. How is it that I'm picking the right PD arrays all the time? This, this. Would you share it? You know damn well you wouldn't do it. None of you would. None of you would. You can say, oh, I would. No, you wouldn't. No, you wouldn't. No, you would not. And I'm going to tell you right now, if I hadn't made the arrangement with the Lord above, I wouldn't be doing it either. And I second guessed it in the beginning. But look at the precision in it. Look at it. It's nuts. It's literally insane. But, it is what it is. So the market trades away from this 98.306 down to the lower quadrant, down into the inversion fair value gap again. Bodies are respecting the inversion fair value gap high. Again, that's this area right over here. This candlestick's close to this candlestick's open. That's what I'm shading because this is originally it's a suspension block. But when it trades above it, it's going to invert its characteristic. So it's an inversion suspension block, but it's inversion fair value gap. Suspension blocks are in the category or classification of a fair value gap. So, and there's a couple more you'll learn about in the future, but right now it's just outside the scope of the time I have here. And I'm looking at the time and I'm like, shit, this is not going to be an hour long. And I didn't intend, it's not trying to be funny. I'm not trying to be cynical or, trying to razz you. I really wanted to get done and I thought I could, but sometimes I just got to remind some of you folks that are listening that you are undeserving individuals. Not all of you, just the ones that talk shit or make sock puppet accounts and talk shit about me. But the upper quadrant's used here, trades down into the inversion fair value gap, this shaded orange hue over here. It's doing that and goes down to the low at 98.112, which is this candlestick's close. Trades to it and through it. Okay. Now, when we look at the market when it's in a deep, deep discount, we're looking at this at a time when we're now in the lower quadrant of the last 20 days look back, and we're real close to getting into the meat or middle part of the lower quadrant area. So we want to be referring to where we are on the daily chart, what PD arrays and what levels are there, and you start on your daily chart, and then have those levels transposed over into your lower time frame, like for instance, like your hourly chart and the 15-minute time frame. I don't use all those time frames when I'm doing reviews because I would never get through them. The average watch time on my videos is 12 minutes. And that's a testimony to why most people feel it's complicated. Because if you're only going to spend 12 minutes, I'm never going to be able to talk 12 minutes and get it all covered. Ain't no way. Nobody could. Nobody could. Go to physics and chemistry labs and see if the professor can talk about what he's going to teach inside of 10, 15, 20 minutes. Not if he's trying to teach you. You can't. So by having unrealistic expectations, you're deferring the success you can have with this by not submitting to the time that's required to learn and learn properly. But if we're in a deep discount down in here, we start now waiting for markets to indicate a shift in market structure. Here is a big, big light year jump ahead. Okay. And if you like what I'm teaching today, this is the moment where you take a second and go up to that little thumbs up. It doesn't give me any money. I promise you it doesn't. But it tells me that you're listening to me and I'm prompting you to give me a grade. If this is useful information that you can see, wow, this is really precise. I can see how this would really help me pick PD arrays. It would help me determine where the draw on liquidity is, where all this is coming together based on this structure. This is the skeleton behind the PD array matrix. Having all these things documented on your chart is useless without this information. This is the like the decoder ring. Okay, it's the cipher that you use to determine what the rhyme and reason is for the market at this given moment. That's what this is. And I honestly didn't want to talk about it or teach it to anybody because I know you all prostitute and bastardize the things I teach, and you go out there and you hide and pretend you found on your own. And all you're doing is putting a big bullseye on yourself because I've already done this with probably 60 different guys on YouTube and called them out saying, this is my information. And they lost tons of business because all their subscribers saw that they're bullshit and it's my content. And they can come here and learn for free, as it should be. So when we anticipate a market potentially going into a shift higher after it trades down to a deep discount here, we went right down into this level here that's 50%, in case you're wondering why this did this. This little 50% line is half of this inefficiency right here from this candlestick's close and this candlestick's open. That's what I've highlighted and shaded. That's the suspension block. When you put the rectangle tool on, again, as I mentioned before, make sure it's top. Well, is it? It's not, is it? What is that anchored to then? Well, it's essentially the same thing. That's what it should be showing. I'm not sure. My eyes probably have it anchored to something else. But there it is. You can see that it's highlighted a little bit darker now. But this indicates that we're in a deep discount and we're inside of a daily old inefficiency and the market's traded down. And then now we can start studying price to see if it wants to give us a tip of the hand, kind of like show its cards to us by wanting to go higher. And that's going to be in the form of a market structure shift. You can see the bodies are respecting. We got a little bit of a wick in here. And then we have that short-term high formed right there, right on top of the low of this candlestick's premium wick. That's this candlestick's closing price. This short-term high, when it pierces through that, that's a shift in market structure. Now, to get in the market there, that's a very high risk because you're basically trying to pick the low of a move. Try not to do that right now, okay? Even for the folks that know a lot about what I've taught for a long time and my veteran students, there's nothing wrong with studying it and saying, okay, let's hypothetically say I'm going to do it there. That's what you should do. But don't go out there and start entering on trades like that, trying to get the best move at the lowest low. Don't do that. What I'm about to show you is how you should do it gradually, and that way your understanding will be comfortably graduated over time, not I expect to know how to do this right away in the first few times and I should be able to go out and make money with it or it's bullshit and doesn't work. That's the consensus right now. That's what all these 20-year-olds or less when they come here, they're so fucking stupid. They listen to other people's opinion and because they don't want to do the work of themselves and watch what it is I teach and listen to what I'm calling out live and see if there's valid, useful information there or not, they subscribe to everybody else's opinion and they don't do the work to find out this is real or not. So by doing it this way, you will get all the evidence, all the confidence that what I'm teaching and divulging to you is privileged information. I'm telling you, if if you go back and look at everything that goes on in price action and you strip the charts like this, none of these moves are going to seem like they just appeared like an aberration. It's not going to be like that. It's going to be like, wow, it's always been there. And then when you look for things in a deep discount and you start looking for price to now start giving you bullish order flow. Okay. I saw a guy post the other day on Twitter or X. I can't call it X. It just sounds stupid. I don't know why they just keep it Twitter. Okay. It's Twitter. But he asked, like I get a lot of times in the comment section of the videos too, what do I think about level two? What do I think about volume profile? What do I think about ladders, DOMs, depth of market, that type of stuff? Or volume analysis. Okay. Before any of that stuff is ever referred to, I have this information. So, what do you think my opinion is? It's dog shit. It's useless. It's not, if it makes you feel like you're confident by using it and you've been profitable with it, hey, there it is. There it is, man. There it is. That's the thing that you needed to make you feel comfortable psychologically to take whatever catalyst or trigger that causes you to take a trade, because that's all that's necessary in the beginning. You have to have a way of calming yourself and not chase everything that pops up. And if you have a rule-based idea using that information and you think it gives you an edge, well, I'm not going to convince you otherwise. If you're making money, how could I convince you that you're not making money if you're making money? I'm just going to argue the case that what you're doing isn't making price go up and down. It's not the cause and effect. This is. Okay. So when price pierces above this wick high, why am I picking that one? Because after this low formed, it started going back over top of this lowest quadrant and it pierced a swing high in price. That's this candlestick right there. See that? So let me make it a little bit broader. There you go. So when it traded above it right here on this candlestick, we want to start seeing what? Bullish order flow. Algorithmic order flow has no requirement of any gimmicks, no level two data, no volume profile, no volume analysis, footprint. It's all bullshit. Okay. It's fucking bullshit. I can't say it plainer than that. Okay. Now I know somebody's going to come out and say, look at my broker statements. Look at what I did. Look at my did here. Look what I did. Okay, wonderful. That gets back to the same thing. You have a religion. You placed all of your faith in trinkets of deceit because that's what that bullshit is. There's no different between that and RSI, Bollinger Bands, whatever. This is technical science. It's all time and price. Nothing else. There's no fluff in it. Time and price. That is it. When price trades above that swing high, we want to start seeing price do two things. Okay. Every down close candle supports price. And I'll explain what that is in a minute. And we also want to see it respect the quadrants. Price goes above, the bodies come down here, but there's a little piercing on that candlestick right there, the wick, and right there. Where are the bodies? Are they above the lower quadrant or are they allowed to go through it and trade below it? They're above it. Big, 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 big indication right there. There's no settings that you need to tinker with, no optimization of my bullshit. The market's optimizing. You don't need to change any fucking settings on any indicator. The candlestick bodies are staying above it. So that's giving you the narrative that we are now in bullish order flow. Do you need a depth of market, volume profile, footprint, level two data? Do you need any of that horseshit to see what I just said right there? You can see it only in price track, the price charts at the time based open, high, low, and close bar. You can't get that information from a range fucking bar, Ichimoku, and any fucking thing else that you want to contrive or construct. It's stripping the advantage. It's stripping it. I don't give a fuck how many schools of thought that you apply to your analysis. Elliott wave, fucking ratio trading, regular candlestick shit, GAN, Gartley patterns. You can keep throwing all the dog shit against the wall all you want. Something will stick eventually, but it's still going to stink the high fucking heaven because ain't no way that I would ever use that stuff. It's ridiculous. This is all that's necessary to understand what order flow is going to do. It tells you when it should start being bullish. It tells you how to trust that it's being bullish, how to identify it. The bodies are saying we're not going to go lower. So start watching down close candles. Do down close candles support price? Because that's my order block. My order block is not fucking orders. I have so many people on fucking YouTube literally running around saying, so yeah, because an order block is a bunch of orders. Bullshit! That is not what the fuck my order block is. That is not what that is. I specifically fucking taught it the very first time. It is not anything to do with orders. The word order is that it's ordering the change in the state of fucking delivery. Okay? That's the technical fucking term. That's exactly how I'm going to fucking say it in the book with the F words included. It orders, it coordinates. It has nothing to do with buying and selling orders. Fuck you guys, man, you're stupid when you fucking out there creating your other extra bullshit. And whatever I taught, anybody that adds to what I'm saying, fucking drop them. Get their fucking asses out of your timeline. Don't even pay attention to them. Because I promise you, they don't know shit. They don't know anything. This is perfect. It's purity. It's perfect. And you start messing with it, you lose its perfection. Watch. Down close candle right here. See that? What we want to do is visually represent, in my mind, I'm looking at that opening price and I'm carrying it to the right. Let me make it blue because it's going to not stand out. I want it to be popping on this chart versus other black lines. It's very disorienting for me because I have all this shit on here, but I'm hopefully communicating this well to you. If this is making sense, I'm going to take a drink real quick. Let me know on X if this is making sense to you. If everything I've set up to this point right now, if this is making you understand a little bit more, let me know right now on X. Tweet to me, text me, say, hey, look, this shit's fire. We're probably going to go for another hour. I don't know how many people are watching the live stream right now. It's probably fucking 3 people. I don't know. Man, I don't see anybody posting yet. So you're either sleeping or not watching. I'm just some guy who says, keep it coming. This shit's fire. Keep going. This is fire. Okay. All right, good. I got 3 people. That's all I need. 3 people. We have a party now. 2 things you have to primarily concern yourself with. Fuck the level 2 data shit. Fuck everything else. Fuck all your gimmicks. Okay. Everything you need to know is time and price. And by having these quadrants on your chart, or at least knowing what they are, then what you're doing is when there's a potential shift in market structure, how do you know it's a shift in market structure, Michael, and not just a retracement that's going to sell off later on? Watch. Watch. We're in a deep discount on the daily chart over here. This thing should, even if it's going to be a short-term bounce, it should at least make an attempt to rally outside of this inversion fair value gap. In and of itself, that's enough to take a trade. That'll give you 10, 15, 20 pips in pound dollar, euro dollar. Go and look at the charts. It'll be there. But looking at the down close candle, it's the lowest one, not just this one. This is lower. That's open is lower than that one. It has nothing to do with the number of orders. No buying and selling orders have nothing to do with this. That opening price is the change in the state of delivery. The order, the word order, is going to order, it'll create the systematic shift in price at that level, at that fucking price, that one. That's what you're looking for. When price is dropping down into it, like right here, okay? This candlestick's opening price is 98.143. And this candlestick's 98.142. It's off by 1/10. And it's the dollar index, which is shit. It's a market that's not real pure. Dollar's always got this weird, quirky bullshit to it. But when you use it with an index like NASDAQ or S&P or Dow or Russell 2000 or bonds or Forex currencies or currency futures, hello, hello. You're gonna see me trading some currency futures here before we get into Christmas. And I'm gonna use the same shit there. It ain't gonna be in Forex, it ain't gonna be in NASDAQ, it's gonna be in index only for right now. But I'm gonna do some currency trading with currency futures. And you're gonna see it's just as precise there too. It's not a one-trick pony. This stuff works in the DAX. Okay, it works in the FTSE. You know, stop emailing me and asking me these things I've already said before. It works in all of those things. It works there. I promise you. But watch what happens when it trades down into that. Then now what's it going to do? It orders what? The change in the state of delivery. The block of time. That's what the part of the word block is. Okay, that block of time sets and establishes the order in which price will change its state of delivery. That is the real definition of my order block. And find that fucking shit in any other Mickey Mouse stuff. It ain't out there, folks. It's not supply and demand. Ain't no fucking way this is resembling anything like supply and demand. Oh, it looks like supply and demand. That's because you're an idiot. Study it. You'll see. This is fucking light years. It's rocket science compared to marbles. You're playing fucking marbles with supply and demand. You're guessing. You have no idea what the fuck you're doing. Demand the fresh zone. There ain't nothing fresher than this. Piping hot and fresh. And then the market starts going higher. Now watch. We go above this lower quadrant. Okay? Big shift. Okay? Big shift is coming. Are we seeing price come back down to that quadrant level? Yes. Does it wick through it? A little bit. And that's permissible. But this candlestick, this candlestick, this candlestick, this candlestick, this candlestick, that is a block in time. You pay attention? Do I need to play some fucking rave music to get you hyped up now? Dance around, look like a fucking idiot. That opening price is the order block. That's the change in the state of delivery. That price, carry it forward. I'm gonna borrow this one. We rally a little bit up here. We fall short and start to break lower. This is the next draw, but it's going to drop back down into this order block. All of these consecutive candlesticks is one order block. Now, when you have a series of down close candles, you can go to the lowest one and be very restricting on your selection of setups. You're asking for the best of the best. There's nothing wrong with that inherently, but it just means that you're going to miss some setups if you're only and always doing that. But when you have a range of candlesticks like it is here, let me make it a little bit bigger and taller. Should be a little bit easier to see now. You're welcome. So by having that open on that candlestick down to that close here, here is mean threshold of this bullish order block. So at this price point or higher, and this none of this should seem hard. This is all basic ICT stuff from my YouTube channel. Like I'm not bending and twisting and contorting things to make it fit. But here is the upper quadrant, the mean threshold, the lower quadrant, and the low of that order block. All these consecutive down close candles. You have to consider the entire range. You can't just, oh, I'm going to only pick that one and expect to get every move. You won't. You won't get every move. And this is probably many times why you see these idiots on the internet say, "Oh, look at this! This is an order block right here. It never even went there. Ha ha ha! ICT's a fucking clown. Ha ha ha! Dude, you're an idiot. Like this is what's going on. You grade it. You want to see it stay in what the lower half for um, the best responsiveness and price action. Do you want to see it appear in the lower half of it or in the upper half of it? What do I teach with order flow using my PD arrays? When it's bullish, we want to see equilibrium or halfway mean threshold. You want to see consequent encroachment or up to the high of the PD array. When it's bullish, you want to see sensitivity in there. And when it's bearish, you want to see it stay in the lower half. You don't want to see it traverse down into this area down here. And since we can measure this, watch, here's a qualifier for you. This is for the people that ain't here really trying to learn, this is going to go right over your fucking head. But for the people that really want to know, I want to know that I know. Give me the details. I want to know every nook and cranny. Butter it all up. The open is right there at the equilibrium price point. So you're demanding it must go down halfway. What would happen if that opening price was down below that? It's even less likely it's going to trade to that as the order block. So now I just taught you when there's a series of candlesticks that make up an order block, how do you use the information? This is how you use the information. Don't buy my fucking book. Okay? Don't buy them. Don't buy none of my fucking books because I'm teaching you right here for free. Please stop listening to these fucking people saying I'm trying to get rich off of books. Why don't I have them out there in the market right now? I'm hot right now because I don't need the fucking money. And this fucking publisher is arguing with me. I want my cover to look the way I fucking want. So that's where we're at. And yes, I'm being a dick about it. I don't care. But it's not that I'm teaching better than the book will, right here. So it goes down to the upper quadrant here, wicks down and touches the upper level of that inversion fair value gap. So we're getting two things. It's using the order block. It's staying in the upper portion. In other words, let me take the lines off. The bottom one off, that one, and I'll take one. So it's inside of this order block, it's this line and anything above. So this is the range right here. That's what you want to see it use. But it trades down and just touches the inversion fair value gap on the daily chart. So you're getting two pieces of information there. Yes, it's trading inside of this entire order block. It's permissible to do that. It could go all the way down to mean threshold, which is the halfway point at 98.171. And that's completely perfect. There's nothing wrong with that. What you don't want to see is the trade down in the lower half of that. In other words, below this on a closing basis, because then your probabilities of seeing a price run higher, it falls off precipitously. You want to see it stay in the upper portion of it, from mean threshold up when it's a bullish order block, from the low up to mean threshold, the lower portion when it's a bearish order block. Okay, so those rules are pretty straightforward. All right, so I can take this off now. All right, and then we get the change in the state of delivery. It rallies back up, falls short of getting up into this wick here. This is a premium wick, but you can grade that and carry it over here just to save time. You do that on your own, but you want to grade that, see how it's being utilized over here. And then it trades right back down into the, was it upper quadrant? I believe it is. Yeah, it's upper quadrant of this premium wick. Now, right away, I already see somebody think, oh, this is a lot. I'm getting confused. Okay, go trade with indicators. Because if you want to see how I'm doing what I'm doing and you really want to learn, this is what I'm doing. And it's already going to filter out a lot of lazy people. And if that makes you angry, if I offend you, I don't care because this is not hard. What I'm showing you here is not complicated. I showed you how to determine the range, and then you look for all the PD arrays and the wicks. Inefficiencies and wicks is the two first things I'm looking for. And they're obvious on your chart. Not every candlestick is going to have a wick. Not every candlestick's going to create an imbalance. So it immediately filters out all the bullshit. Only things that are salient, that's what you're looking for inside that 20-day look back. Market reacts, comes back down to the upper quadrant. Does it respect it? Yep. Sends it off again. Comes back down, wicks into it again, little tiny coloring outside the line, but watch the body. This body stopped here. We opened here, traded down. When it trades live and trades down there like that, you want to anticipate it do this very thing here. And you want to see this candlestick or immediately the one following that. In other words, say this candlestick closed anywhere but below this black line here, the upper quadrant. If it closed anywhere like that, the next candle we would demand, okay, because I supply and demand, and I demand respect for the stuff I'm sharing. That's the real supply and demand right here. The idea would be is to expect the candlestick to start raging higher like that because it's already showed a willingness to come down here a couple different times, and now it enters a macro. What time is that candlestick right there? Look at the bottom of your chart or my chart. 6:50. Man, that's random. That is absolute fucking bonkers, man. The timing of that run off of that quadrant after the shift in market structure, I taught you how to validate. You're in bullish order flow. All the things are sitting there telling you it's respecting the quadrants and down closed candles. Series of order block. Does it support price? Yep, it rallies. It's in it again here. It rallies off the quadrant and then it tags it one more time. And now it's time to run. We're entering what time of the morning? 7 o'clock to 10 o'clock. That's the time of the day. I told you every fucking day it's going to lay it down on you. Here's the opportunity on a silver platter. Do you know how to find it? Between the last live stream I did, October 1st live stream, and today, you have now learned more than any fucking person can ever teach you about technical analysis with precision that they could never dream of. You can literally piss in the cornflakes of everybody out there that says that you can't time the market. You literally can laugh in their face. Like, what do you call this? If this is not timing the market, what is it? This is exactly what everybody says is impossible. What the hell? So anyway, it rallies off the macro and then trades all the way up to that random level of, I call it this upper quadrant. It's lower quadrant. Excuse me, earlier back there. 98.306 is the equilibrium price point or consequent encroachment rather of the wick. Trades up to it here. It comes right back down in. What's it doing right here? What is that? Buy side imbalance, sell side inefficiency, BISI, and watch. Order block. Changing the state of delivery. Carry the opening price over. It trades right down into that candlestick's opening price. Hammers it. Does it respect it? Yep. Do you have to look at a level 2 data? Do you have to look at the footprint to see what's going on? Fuck no, you ain't gotta look at that garbage. Why? What do you need to have something else to distract you over? It makes you feel smart. That's what it is. See, this is elementary. This looks too, well, basic. Nobody's going to look at this and say, wow, man, you're Tony Stark of the charts. Look at that. Wow. I don't need gimmicks. You don't need gimmicks. You're here to make money. That's what you're here for. You want to learn how to time the market, go in here and find setups that yield itself to you, not waste your time with Mickey Mouse setups that don't work, using archaic language and theories that are fucking horseshit. That's why they don't come out here. That's why they don't tell you this is the candlestick it's going to run. This is the candlestick it's going to go to. It's not going to do this. It's not going to hit that level. It's going to stop at the 75 level. But those relative equal lows, Michael, I have to hold some things back. I wouldn't be ICT if I wasn't. So anyway, price sends it here, and we trade through the consequent encroachment level at 90, whatever it is at. 98.306. Right there, yeah. And then now watch again, we're above it. and it comes right back down. Are the bodies telling you that order flow is still bullish? Based on what I just taught you. Very simplistic language, very simple. When order flow is bullish, the quadrants and down close candles support price. In other words, treat that as your real support and resistance. That's the shit that really works. This is not in books, but I guarantee you someone's going to take this video and create AI generated bullshit and they're going to be on Amazon before the end of the weekend. And you're still going to be fucking wrong because I ain't giving it all in one fucking video. But does it support it? Yes, it does. Can you see it trade just a little bit above with these two wicks? Yep, that's permissible. Why? Why is that permissible, ICT? Explain that to me, because I would be nervous if it was traded down here like that. Well, what is this? It's a fair value gap that's laying directly on top of that consequent encroachment level at 98.306. That's a high probability. Ready? High probability fair value gap. Yeah, TikTok fuckers. Yeah, you assholes. Want to talk shit and sidelines? The safety of the sidelines. It's proven it doesn't work. Really? It doesn't work in your hands. That's the only place it doesn't work. Because it works real good in mine. And for the people that are learning what I'm showing you here today, in the last couple of live streams I've done, I have done a master class. I've literally pulled the fucking curtain down, and you see the wizard now. Okay? You're seeing him. You are seeing the maker. Okay? Here it is. The bottom line is that it runs right back up to upper quadrant at 98,402. Trades through it, fall short of the upper level at 98.499. That's this candlestick's wick high. And then it starts to retrace. Do you freak out? Do you lose your mind? No. Here's where you have a change in the classification of what is permissible and what's not permissible. When we are in the lower half or at consequent encroachment of this kind of wick on the daily chart, the lower portion of it, that's where the real pure, you demand that the rules must be followed. They cannot deviate. They can't have any kind of, well, coloring outside the lines. It has to show you the support. The down close candles and the quadrants must be supporting. But when we get on the upper half up here, what happens is the price will and many times go into like this area of consolidation. Then you'll see stop hunts. You'll see using retracements that go below a short-term swing low. And then the real move ensues after that. But that will occur from consequent encroachment level up to the upper half or the high of it. That being this candlestick's premium wick. Okay, so from here, yes, from the consequent encroachment level of 98.306, this is a run that is favorable. But once it originates here, we shouldn't expect with any kind of fear that there's going to be retracements to that level after it's already done this type of parabolic run. But the retracements that occur in the upper quadrant, they can come back over top of that upper quadrant, even though it's listed as 0.25. It's because it's this level here. Bottom line is it trades down through it and then back above it and then rallies up to the high here, then back down. Now, this is the stop hunt I was telling you. It's always going to occur in the upper half. Here's consequent encroachment. Think about if it's going to move, chasers are going to see, oh wow, look, it's running now. Dollar's probably bullish. And they retrace it. They lay a trap down. They show a breakout above this old high. They're not using this quadrant level. They're looking at this high being broken out to the upside. And then they see a bull flag. They say, wow, I'm going to keep adding there. And then they shit the bed and come right back down for their stop in the upper half. How does ICT know when they're going to do a stop hunt? How does he know when it's a market structure shift or just a stop hunt? I just showed you. By having these ranges graded, it pulls back the veil and shows you exactly what it is that you should understand about what's permissible and what's not, what should and shouldn't happen. Now, if you're brand new, if you're really, really new to my stuff, this is going to feel like it's over your head. But for the folks that have been with me for years, you have now literally been jumped forward light years ahead in understanding. Like this is like Viagra for a technical analyst. Like you are fired up. You're running around with wood right now. And ladies, out of respect, you're just happy. Let's put it that way. Stop hunt taken, supporting a quadrant. Yes, we wick down through it. Why is that permissible? We're in the upper half of a bullish order flow. Volume imbalance. That's the only inefficiency. Why am I not able to see? There you go. I'll say I paid my bill, man. What's going on? The volume imbalance right in here. You can see it trades right down to that little inefficiency right there. It doesn't need to go below that low. For the folks who are saying, why wouldn't you be afraid it's going to go below that? Because it's already done that. Right there. That's the stop hunt in the upper quadrant. There's the little stop hunt. Boom. Leave a volume imbalance below the quadrant level. Rally, it gets a little muddy in here. They use this inefficiency here to send it right back down just to get that volume imbalance and scare anybody else that maybe has a stop loss here or they think this is a big bear flag. And they would chase it going lower. And then it resumes back to supporting the quadrant. And now watch, we have another run away from it. After it's done this only inefficiency down here, we go back to looking at the order flow with the order block. Down close candle, opening price, draw it out. Is it supporting it? Is it staying in the upper half of that? Yep. Rally. And it runs up to the high of that wick again. So now that was a very, 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 very long discussion, hopefully fruitful. Hopefully it answers a lot of questions. I'm sure for some of you that are brand new, you have a million more new questions. And that's good. I want you to have questions because that means you're going to go into my content and you're going to study, or you're going to listen to me when I post stuff on Twitter and you're going to say, okay, what does he mean by mentioning that? Let me go in here and use this information. And it's going to be suddenly interesting how all of a sudden you can catch up to what I'm saying. Why didn't you teach this from the beginning? It would have been so much easier. Yeah. And I have more people than I have all around the world ripping me off. I'm making millionaires, not only in trading, but I'm making millionaires because they're teaching my shit and saying that they found it themselves and changing the names of it. I'm not guilty of that. They're the one rebranding, but they can't do this. I promise you, they'll show all their trades in the past and it won't line up with this logic. It'll just be lucky they got here and there. And you'll see when they failed, it was not using this. But they'll never do that. They'll never share that stuff. So anyway, that's the business. We can finally move over to euro real quick. I'm not going to do all this on euro because we'd be here all day. But a bullish dollar index allows for risk off. Higher dollar, risk off, meaning euro dollar, because it's the first currency in the name of the pair. If dollar's going to go up, and it's a teeter-totter effect, dollar up, oops, come on, dollar up, euro down. So we can see all of these same elements being showed here on euro. Order flow would be, hold on one second, euro USD. That's the business on that. And you own your own time. Go back and do the same thing on Eurodollar. Friday, day one, count back 20 days, grade that level, and look at how price is going to do the same thing. You're going to want to watch this video again to see what I was doing, and then do that same thing with the pound dollar. Do the same thing with any other currency, any other market, really. But and you'll see all the rhyme and reason why it's dropping down here. Incidentally, you also will have the advantage of knowing how to structure my market maker buy and sell model, which is not Wyckoff. They match up, and all the high significant second stage reaccumulation or second stage redistribution, the unicorn, they will always lay on one of these quadrants when you're doing it. Oh, yes. Oh, yes. It's that good. It's that good. It never misses. Holy shit. He said never. And I said never. It never misses. It never misses. Find that in any other school of thought because it doesn't happen. That's why they use language like, well, that's why the market's random. It's an even distribution of random price action. So you never know. Nobody really knows what price is going to do. I love it. So anyway, your handwork is to do that with the euro dollar, pound dollar. I want to get to the um, the Nasdaq. I apologize. I just don't have the time to be here all day. And same business here. Oh, there's a lot of structure in this. This will be interesting to study that one. But same thing. Go back over 20 days. Look back on pound dollar. Make sure that you're toggling for the levels to be carried over into your lower time frame charts. And you'll see there's an epiphany right there. It'll be like, what in the world? You're going to start hearing the angels singing, harps be playing. You're expecting the golden light to shine down on top of you. It's going to feel like you've been anointed because I'm telling you, the level of perception it gives you is God's gift because that's what it is. There's no way about this that you can subscribe it to any other school of thought. That's why nobody else should get the credit. It's Him. Him. Okay. So anyway, um, gold. Let's do that real quick. Gold December contract. All right. So if you recall, we were in this area in here. I posted a tweet and I said it might be time to take some profits on gold. And you can go and take your Twitter, go to my post and get the link for it, and then go to your chart. It would be better doing it on the daily chart. Right click on the chart and then click paste once you have the tweet that I posted saying it's probably close to time to taking some profit. That's not me picking the top. Okay. It's start considering taking some profits off because we went into a parabolic price run and we're at all-time highs parabolically. If you don't pay yourself something, I didn't say close everything out. I didn't say go short. I said consider taking something off because in 2022, in 2019, the summer of 2016, I said to buy gold. And you can go back and look at those recordings, and it's there. I never said sell gold. I never said short gold. Okay. Um, but the point is that we've seen gold rally, at the beginning of the year. Like, I mean, that's a lot. Like, that's huge. We've moved into consolidation here, and then we've had a nice price run. Why did I post that? It might be time to consider taking some profits on gold because we've had basically a measured move. Now, watch right here, like right in here in this consolidation. What I'm doing is I'm trying to get a rough idea, eyeballing it, where halfway is. Okay. Right there's the first point. So we have low to equilibrium and all this consolidation. And then the next leg would be up here. And I don't have the other one showing. Why? Oh, I forgot to look it over earlier. Okay. So knowing that we are now in the upper quadrant, what can happen? What can happen in the upper quadrant of this price run that we just graded? We've realized the price run up here, but we're approaching, if this is the halfway point, and we can see this because of this run up and then consolidation. So you can predict where measured moves will start to peter out in momentum. Not that they completely and utterly reverse there. It can, but we want to know when it's highly likely to have deep retracements. But why would we expect it? Why was I expecting this type of bullshit here retracing back down? How could I have known that? What did I just teach you about the upper half? When you have a price run or an inefficiency or a PD array or a range, when it's bullish, you're going to get that dirty price action in the upper half. When they start getting close to targets and levels that it's been reaching for, and all year long this thing's been going up after a consolidation in the middle like this. Basically, if you just take your fingers and put your thumb right on top of the low at the beginning of the year and then the high right there, that range, add that to halfway, and you'll see that that's pretty much where we're at right now. But I want to be in there early, indicating to US students, hey, look, if you own this stuff, it might be a good idea just to give something to your bottom line that's real, Realize some gains because unrealized gains, you can't buy groceries with that. You can have all the P&L on your screen while trade's open. Man, look at all this money I'm making. You ain't making shit until you close the trade. And because I'm looking at you as developing students, that you're not really firing on all cylinders because you're learning still. Otherwise, you wouldn't be following me because that's what a perfect graduated student that knows exactly what they're doing will not follow me anymore. That's what I want as a mentor. Every mentor should want that, not somebody that's tethered to me. I don't want you watching my social media. I'm not trying to make money off of you. I'm literally on most of my time on X, which is not monetized. I'm not monetized there. Okay. So knowing that the dirty stop runs are going to be in the upper half of that when it's bullish, and we were approaching that level early on, you can drop that tweet once you get the link off of it, and you'll see it's pretty much as we were approaching that level. That's why I told you that expect some, profit taking. The market rallies up, stops dead in its tracks, and says, "I'm not going to go to 4,400 rather." It just stops and leaves that equal high up here, which I find it interesting. Then it drops all the way down into its inefficiency. I believe I did this right. If you look at the close there, it's 159.6. And then the open on this one is 160. So there's a small little separation there. So there's a volume imbalance there. And the same thing with this candlestick's open. Comes in at 225.1, so 25.1. And the close on this one is 24.9. So it's lower on this. So there's a small little volume imbalance there. So that's why it's shown there, not on the wicks to wick. So it retraces back down into the upper half. And if it's still going to be bullish, now think about what I taught you. If this market's still bullish, does it want to trade the consequent encroachment of this suspension block? Would it do that if it's bullish? It shouldn't. It should fall short of it or stay above it, in other words. And that's what you're seeing here. And you had this retracement off of that while we have relative equal highs. So that sets the stage for an attempt to get back up to this level over the next coming 2 weeks. Now, why am I saying 2 weeks? It's just a reasonable time frame when you're using analysis on a daily chart because it could stay in here and range around a little while and then come back up there and get it later on. Or it can come right out there on Sunday and go into Monday's trading and be already up above it and just make even higher highs. So, I mean, that's what I'm trying to say, that you don't know and I don't know where this market's going to go because it's in discovery, meaning that it's at all-time highs. Nobody knows where this thing can trade to. But it's foolish for anybody to hold along from the beginning of the year or anywhere and be making this much money unrealized and not take something off when we're up at these very lofty levels from a measured move perspective. And if you don't learn to take something off and you think that you have to have your entire position on or you're not satisfied, you are gambling. That's what that is. That's a characteristic and a trait of a gambler. You want all of it. All or nothing. I used to see a guy, people still think he's something, but I don't think he's anything. They say, you know, I I can't understand why somebody would put a trade on, put a stop loss on, and then take partial profits. It doesn't justify the means of having your initial stop loss. Well, you dumbass, the stop loss is going to evolve into eventually locking in potentially some measure of profit. But even then, it's not guaranteed because the market could gap down. Let me pose a hypothetical situation for you, okay? Let's say, for instance, it's you're long a market. Say you're long Nasdaq, and you place a stop loss in, and you're risking 10 handles to make 100 handles. That's a pretty good R to R. Your R multiple solid. It's 10 to 1. You're looking at a really respectable rate of return if it comes to fruition. Once you trade to 40 handles in profit, you roll your stop to break even plus commission costs. Okay, wonderful. Theoretically, you have what we call a free trade. It's not guaranteed that you're getting out with that if it starts to reverse on you because you have gap risk all the time in markets, especially now in the climate that we're in right now. Anything can happen. If they dropped a nuclear bomb, okay, let's say a particular country in the Middle East dropped a tactical nuclear bomb in another particular country, and I'll just leave it that way because I'll probably get smacked around by YouTube if I say who I'm talking about. What do you think the market response is going to be to that? You're going to see the market be trading here, and then immediately the next tick down here. Your stop loss is not going to work. That's inherent risk that we have as speculators. That's what those big papers that you're supposed to read all the time when you open up an account, they're telling you that. And when they tell you when liquidity is available, we will do our best to get you out. That's what they're talking about. Because those environments do exist and they've never been as high as they are right now. So anyone that's out there trying to leverage their accounts really, really big, you're an idiot. You're asking to have your head cleanly and efficiently removed from your shoulders financially. You're not respecting the risk. You're not respecting it. I'm not trading with size right now. I am not putting size on right now. And anybody that is a gambler. And when you make money that way, don't parade that shit on social media because literally that is you begging. You're begging to get kicked right in the balls. And it's going to happen. It's going to happen. And it's going to happen at the worst time with the biggest loss. And it's going to freeze you up. And then you're going to be afraid to take any size at all. And that's why you don't want to do it right now. If you trade with real small size, real respectable, even if that means you have to trade in the micro, do it. You're still doing better than everybody else, but you're trying to measure it against your expectations or measuring yourself against me or someone else out there that's supposedly doing well. Fuck that. None of that stuff should matter. Either you're doing it the right way and seeing results that are compounding into greater understanding, and your demo trades are showing profitability, your tape reading showing continuity and consistency, your understanding of what the market's likely to do, seeing it live is increasing. That it will eventually, at your own discretion, lead you to determine and decide when you're going to put real money at risk. That's different for everyone. But when you make that decision, you need to be able to own all of the responsibility. And I have students that will cheerlead and say, I love you, ICT. I love you. You're the GOAT. You're the king. You're the greatest of all times. You're the best. You're everything. You're him. And then if they do something wrong in their own hands, they're bitter. Just saw it. I just boxed him the other day. Fuck you and your wife. Okay, fuck you. How about that? Like literally, that tells you that guy lost money. I didn't cause him to lose money. I didn't fucking tell him to buy or sell anything. But that's somebody that's not equipped. They learn from anyone. And in this climate, I warned you, I told you all that we are going to see price action that's fucking insane. Look at the previous 2 Fridays ago. Look at that. You didn't see it coming. You get mad because you hurt yourself. And if I show you I did anything in an economic climate that's, you know, elevated risk, I'm somehow a villain. What I do has no effect on you as a student. That's the proper mindset. Whether I make money or don't make money, whether I take the trade today or not take the trade, that's not why you're here. If you're here for that, you're here for the wrong reasons. I'm spending my time on Saturday teaching you the highest degree of reading technical charts and anticipating when the market's going to move and how they're going to move. This logic will work in the future. It's not going to stop working. I'm not here to put you into trades. I'm not here to go out here and do it live so that way I can copy you, ICT. Because if you're willing to do it with live money in a real account on live stream, that means that you care enough that you think it's going to make money. Because why else would you come out here and do it? And I want to copy you because I'm so hungry and I need to make money right now. And that's tethering you to me. I'm not going to allow that. And when I tell you things on Twitter and I'm calling it live, I'm pointing to this, pointing to that, saying this, watch that. That is not me prompting you to take a trade. That's why I'm not liking your post. When you say, oh, here, look, thank you, ICT. I made this much money. Look at this profit. I mean, man, what the fuck? Stop doing that. Stop doing that. Every single time I read that, I fucking cringe because that gets in my head. That means that there's even more of you not listening to me. If you're doing that behind the scenes and you're making money, God bless you. Okay. That's not why I'm doing it. But please stop telling me that you're making money doing it off of what I'm saying live. That's not why I'm doing it. I'm telling you to watch it and tape read it. Every single time I see people doing that, I'm thinking of the person, the last one I just read that they made money. And the next time I call something, I'm thinking, how many contracts are they buying on that now? How many fucking contracts are they over leveraging now? And that's going to affect my visibility. That's the thing I'm going to worry about and versus reading what I understand about price action. I'm going to have a retail handicap when I don't have a retail handicap otherwise. I don't think like retail traders. I don't trade like retail traders. I don't fucking do anything like a retail trader. But when I have your risk in my mind, when I have the outcome of your fucking trades on my mind, I'm forced to have a retail perspective. That's why I tell you not to do it. I don't have those weaknesses unless you give them to me. It's kryptonite. I don't want to fucking do it. I don't want to think that way. I don't think that way. But when you share a lot, and I understand, okay, don't get me wrong, okay? I understand that you're happy and you're excited and you feel that you have to do that. And if I don't see that, I'm gonna somehow just get no longer interested in teaching. That's bullshit. It's bullshit. Listen, I know there's people listening to me. So I know when I talk, someone's gonna listen and they're gonna learn. Okay. Don't be afraid that I'm gonna fall out of interest in trading or not trading, but in teaching because it's in me. It's who I am. I don't need all of you to cheerlead me on or give me your successes that I'm somehow going to be like, wow, yeah, now I want to continue. Because what I continue on and the fuel I have is your appreciation for me spending my fucking time that I don't have to do. I'm not getting fucking rich off of this. And literally, nobody else would do this. I'm investing in you more than you invest in yourself. And that ain't bullshit. I am believing that if you listen to me the way I teach it, you will absolutely be able to see the things I'm teaching, doing beforehand without any hand holding. You're going to know the PD arrays I'm going to talk about before I mention them because you're using this logic. That's success. That is growing. That's becoming independent. That's you getting ready to boot yourself out of the nest and say, you know what? I appreciate it, Pops. I got to go. I got places to go and it's time for me to fly. You're not coming back. Hey, let me see what ICT's up to. Fuck ICT. I'm doing this. Now I know what I'm doing. I'm making it easier for my family to eat. That's what you're here for. Anything less is bullshit. Anything more is extra. You don't need to. So don't feel like you got to keep giving me your successes. Like I need that. It hurts me when you do that. And I don't know how to make it any plainer than that. I don't want you to. Man, let me get it. Hold on. I gotta get a pillow against my back. This wooden chair's fucking hurting my. Sitting at the dining room table, and this freaking chair is uncomfortable. My ass is falling asleep, actually. But the hindrance it places on me mentally, it causes me to shut down. Like I don't want to do anymore. Like I don't want to do it anymore. When I see people posting, man, this is the greatest fucking trade I've been in, or this is it worked out perfect. Look at what I made. I can't believe this. Oh, okay, I understand your excitement, and I don't want to steal that from you. But just know that what I'm saying here, it matters to me a lot because I like what I'm doing. And the more that you all tell me what you're doing with your money based on what I'm saying, you're breaking the rule of Fight Club. The first rule is we don't talk about Fight Club. We don't talk about what we're doing. We don't put it on social media. You don't need to send me emails and tell me anything either. There's no difference if you put it on social media where everybody sees it or if you send it to me in email. I don't like those kind of emails. I appreciate and I understand that you're excited and you're doing well, and I understand what is motivating you doing that. But I'm asking you, as a man, the frailty of the person Michael is asking you, please don't do those things because it messes me all up in my head where I start now thinking about the outcome versus following just simply the logic. Because if I have dozens of you that I know that are repeat offenders with this stuff, I know that you're going to over leverage. And if you haven't, you will. And eventually, something like Friday, 2 Fridays ago, is going to happen. And I might not be firing on all cylinders. I might not be paying attention. I might be distracted with something going on in my house. And that's the day it happens. And you get hurt really, really bad. And you're going to want to blame me for it. And I don't have any connection to it. I won't have any connection to it because I didn't put you in that trade. I didn't tell you to buy or sell that many contracts. I didn't tell you to put your stop loss there or not even use one. But you'll find some way to attribute the outcome and responsibility to me, and it's not. The only thing we're talking about is price action. That's what we're doing here. That's what this community is about. Telling me what you made, I don't want to see it. I don't want to see that. Share that with your journal. Champion that there, but not to me at least. Okay. So anyway, the market traded down to this inefficiency and it respected the upper half, which is exactly what we want using my order flow ideas. So algorithmically, it did exactly what we expect. Now, what we don't want to see going forward, and let me say it this way: what I don't want to see is I don't want to see the remaining portion of that separation. I don't want to see that close in before a new high forms because that means that this has stayed true that it's not willing to go into deeper discount. And so if it's not willing to go into deeper discount, they want these relative equal highs. Okay. So that's how I'm looking at gold going forward. If it trades back down below that, okay, then we would probably consider using this inefficiency in here. But to do so, I think is really problematic. I'm not problematic long term, but for immediate, intermediate term, time horizon, if it goes down here, I don't think we get back to the highs soon. But we can very easily get to new all-time highs while we're here. Okay, so hopefully that was beneficial for you. NASDAQ, we finally made it here. It's a long way around the barn. Alrighty, and NASDAQ 2025. All right, let me clarify a couple things real quick, and then we'll finish this live stream. All right, daily chart here, and I'll maximize it. Okay. But not hurting your feelings, and I mean that sincerely because I know I have a lot of influence, and I'm not trying to steal your excitement and joy when you succeed with this stuff. But I want you to just think. And maybe you don't understand what I'm saying and why I'm saying it. It's not me trying to be humble because believe me, it's not humble. It's me telling you that you're hurting my advantages and you're putting things in my mind that I don't normally have to wrestle with when you tell me what you're doing with the information I'm sharing live. If you want me to stop doing that shit, keep doing it because that's exactly what's going to happen. So anyway, um, 2 Fridays ago, we had this really big sell-off, which I indicated and told you why that took place. And I know a lot of people that now, since they've reached out to me, they know people that got hurt. And I'm not trying to make fun of them because I feel terrible that these types of things can hurt traders. You know, it's one thing for us to make fun of retail logic, but I'm not making fun of people. It's the logic that they use. That's what I attack. That's what I mock. I'm not I'm not trying to be a bully and bully individuals. I'm trying to just make a mockery of what they put their faith in. And you can argue semantics and say, well, you are bullying a person when you're doing that, but that's not really what I'm aiming to do. So if you think that way, that's not what my motivation is. But 2 Fridays ago, that obviously destroyed a lot of people. Like it wrecked a lot of people. And I indicated that because we have a large gap here between these two price points, where we closed 2 Fridays ago and then where we opened the new week there, that's the new week opening gap. Okay. And We traded into it here, and because of the previous Friday, it dropped so far down in there, and that gap still remaining, that there's gonna be a strong interest for price to wanna go back down to that in the eyes and hearts of traders. Like, they wanna see that happen down there, but if you blend in what I said about the dollar index, if it was to go lower on its daily chart, then it would cause the Nasdaq to go higher. So that's you taking what I said about what retail would expect, okay? Like when I'm talking about opening range gaps at 9:30, where we open at 9:30 opening, and where we settled at the previous day at 4:14 p.m. Eastern time. Those two price points, you have to have those mapped out on your chart. Price need not fill in that gap the day it forms, or even the week that it forms. It could do it weeks later. Don't believe me? Put your chart on NASDAQ and put on regular trading hours, toggle it to regular trading hours, non electronic trading hours. And you can look back in the past and see there was gaps that stayed open for a month. Just because they gap doesn't mean they must fill right away. And the same thing here. It's such a huge gap, and it's baited people to anticipate it going down there and continuously going lower. Look how many times they offered that here, and even went lower there. So at this point right there, I'm sure everybody at the time thought that this thing was going to go down to there and lower. But that's exactly how they're using that range that they created 2 Fridays ago. They created a killing field. It's like a landmine field. Okay. So you have to use every single day's wick, grade them and carry them forward. Know where the opening price is and closing prices of every daily range, the high and the low, and that's how you navigate in this. That's exactly what you have to do. And if you watch what I was showing you this week, that's what I was focusing on. I was pointing your attention to those very things there, not look for it to kick out Friday's low from 2 weeks ago, staying inside the range. I mean, we stayed, well, before I do it, think about what I taught you in this lecture here. Think about it, what I just said about grading the range. Hopefully, none of you could disagree that this is the range that we're inside of 2 Fridays ago. That's the range. So it's this. Until we get above or below this individual day, we're trading inside the range. And it's defined with that shaded area. That's the range. Okay. But inside that range, there's quadrants we have to be concerned about because that's what the algorithm is going to refer to. Inside of this big range of price action, that is that's the most significant one. We don't need to go all the way back 20 days. This is the elephant in the room. This is it right here. So we have to leave that range before anything else is useful. Do you understand that? I'm not I'm not saying that 20 days ago's look back period for if the data ranges isn't um, useful here. I'm saying that even before we get to that, this is what we have to concern ourselves with because this is the biggest range that we've not moved out of yet. And it's a huge aberration of where it come from. Most people didn't see it coming, but we all see it right now in our charts. I promise you, every investment bank, every hedge fund manager, every person that ever trades with real super size, they have this range in mind. They are waiting for this thing to lose its high or low. That's what big hedge fund traders are doing right now. They're not doing anything in here. And that's the truth. They have to leave this band of volatilities low and high before they can ever start to do anything new because they can't trust that it's going to move higher and they can't trust that it's not going to move lower. So why would they assume more risk with so much uncertainty? They wouldn't. They're trading with billions of dollars. not a $2,000, filtered, limited demo account that you got 20 of. Your perspective on the market is completely limited to whatever's making your jock itch right now. They got billions of dollars at risk based on what they do in allocation. So they're going to wait for this band of volatility, the highest point and the lowest point, to be removed by new discovery, higher or lower. And I don't give a shit what approach they use. That's what they're waiting for. So as a trader, as a day trader, as a swing trader, as a short-term trader, a scalper, until we leave this range that's defined here, we're going to work around like we've been doing all week. And if you don't like those types of environments, then just take a couple weeks off and just come back every day at the end of the day and see if we've taken the high out or the low out. Because then you're going to get a different degree of price delivery. I'm not teaching buy a breakout and sell a breakout. But I'm telling you, wait for that band of volatility to be taken out. And now we have exploration into a higher all-time high, or we're resuming the damage that was done on that Friday. I promise you, what I just said here is very, very crucial for you to understand how to behave as a trader going forward. If you don't adhere to what I just said, you're going to take unnecessary risks. You're going to trade more than you should, and you're probably going to hurt yourself. And because I'm trying to teach you a way to prevent majority of that, I can't produce a way of removing all the risk, obviously, but to maximize the probabilities in your favor and hopefully filter out the likelihood that you could potentially hurt yourself, you need to understand these things. And by knowing this, we can now grade it. 2 Fridays ago is high, and that's doing the same thing that we would look at with the 20-day look back, the highest high and the lowest low. If you ever have a big event like this, start there. And then when we leave this range, then we can go back. Like if it goes below here, then go back 20 days and then use that range. And it'll make much more sense to you, okay? But we have this is graded now. Carry it forward so that way it's going to show up on all time frames. I'm going to scrunch this up. And that's these levels here, okay? And suddenly you'll see the rhyme and reason as to why price. Actually, let me do it from this end. It's easier. It only moves a little bit when I do it this way. You just put a number in your ICT. I know. I love pissing some of you guys off. Da, da, da. I'm gonna get a drink while I'm doing this. Remember the parable about the jade master? It's all about patience. You learn through patience. All right. So look at this response down here. It's respecting the lower quadrant and then rallies up. What did I teach you about grading ranges like this? Inefficiencies, PD arrays, gaps. What did I teach you? What did I just fucking say in this lecture? The meat, all the things you're going to look for is going to occur at consequent encroachment or midpoint, okay, to the lower quadrant and up to the upper quadrant. Inside this area in here is where 90% of what you're going to look for as a trade is going to form all the time. And when they occur with individual inefficiencies and wicks, and those quadrants are forming new PDAs around it, in that, you're going to get the best setups and best things that deliver. So you're not going to, let me put it this way, you're not going to waste time looking at things and thinking they're PD arrays, and they're really not. They're not high probability. So if dollar went lower, and we can all agree that it went lower, the filter was going to be, if it went lower, then the NASDAQ would start to go higher and make an attempt to try to challenge going into the upper end of this band of volatility that was created on 2 Fridays ago. We traded down to the lower quadrant of that previous Friday's range here, and look how it gave up and went all the way back up there. Again, we went down to it again here just to take out that low, and then look at the reversal all the way back up and closed up higher. What is it showing you? The logic, what I told you, when you're grading these ranges, when you're bullish, the lower quadrant to the consequent encroachment, that's going to be the meat of where your big bullishness is going to come. Yes, on the wick part or portion on a daily chart, it's going to have a little wick down here. But if you're looking at it on the lens of a 5 minute chart, you're going to have candlestick bodies down there. So you have to permit things from a higher time frame daily chart. In other words, if it was doing the bodies closing below that quadrant on the daily chart, that's a problem. We don't want to see that. But having the 5 minute chart here, having candlestick closes and the bodies below that daily range here of that lower quadrant of the Friday, 2 Fridays ago's range, that is not disturbing anything. You're going to have to allow for that to happen. And that's just simply understanding the continuity between one time frame to the next. What something looks like on a higher time frame chart as a wick is going to have lots of candlestick bodies on the very, very low time frames. And that's just something you're going to have to get real used to understanding and expecting. It isn't going to create a wick on a 5 minute chart like it does on the daily chart because it has to spend time booking price down there. Whereas on the daily chart, like that's a pretty good amount of handles to offer and not just do it on one little flash of here's one price above 24,466, and then one tick, it only goes down to the lowest low, and then it leaves it again above it. And that means you'd have a wick only on the 5 minute chart. That's not going to happen. If you expect that to happen, you're going to be frustrated. So just be comfortable with knowing that bodies below this level here, when it looks like a wick over here, expect bodies to form on the lower time frames. When it's a wick, you're expecting on the higher time frame. I guess that's the easiest way of saying it that way. All right. So we're at 2 hours now, and I went another hour longer than I wanted to. I want you to take what it is I taught you today and covered and spend some time over your own pet markets. And you'll see that what I'm teaching isn't limited to the things I'm showing you here. And this is your consequent encroachment of that full Friday band of volatility. This huge daily candlestick. We graded it, and now we're going to carry that over to a 1 minute chart. I'll say this, and then I will close for today because I'm kind of hungry actually. And I'm using up all my time, and the girls are going to come home, and I'm going to be like, man, I had fun teaching you all, but I wish I would have just did this instead. The little boy in me wants to run around, play real loud music, and just carry on like a kid. That's what I am at heart. I'm a kid at heart. But I want you to know that the books aren't going to teach you what I did yesterday, where I told you I was going to stop at 24,675 and told you that was the liquidity pool. That was it. And it wasn't going to take these lows here. Just so you know, it's not bait to buy the books that learn that. That knowing where my stop losses go, I'm going to teach you some things, but you will not be able to replicate what I do. I'm keeping that for myself. And I know that's going to make a lot of you mad, okay? And it's not meant to make you mad. It's not meant to tease you or anything like that. I want you to know if you do decide to buy these books, just know that you're buying them without needing them because everything I'm going to talk about in those books is on this YouTube channel. And you have a better examples of being taught visually over the charts versus looking at a static chart where it's limited. I can only draw so much of your understanding into an expression of what I'm teaching in a static chart or a series of static charts in a couple paragraphs. It won't do any justice to it like if you listen to a lecture like this one. Can you imagine how many chapters it would take for me to do what I'm just done today? I mean, think about it. When you ever read a book, you know, it's multiple chapters I covered today. I'm writing fucking books every time I do a live stream. Every time I did a Twitter space, I'm writing a book, like a book. So that's how deep you can go. And I want you to see this uh, consequent encroachment of previous Friday's week range from the low up to the high. We graded that. Okay. The consequent encroachment level right here. What what was dropped on top of that? What's this? Isn't that a bullish fair value gap? See that? The market drops down into it, gives you institutional order flow entry drill, which is a partial fill of the gap. It's a high probability fair value gap because it's laying over top of a quadrant. What do I mean by laying over top of? Okay, this is the last thing I'm going to teach, and I'm done. If this, say, this is your candlestick, okay, it's a bullish candle, right? And you have a quadrant level. And the next candle that's immediately formed after this one does this. And the candle prior to this one looks like, oh, I don't want to do that. Just one candle. Pay attention to this part, okay? I promise this is going to clear a lot of your confusion up. If this is the quadrant, you want to see any portion of this candle that makes the actual gap or the fair value gap, it needs to be laying on top of this line. So you would naturally have it viewed like this. And so that's your normal ICT bear bullish fair value gap. Okay, crude depiction, but it's accomplishing the method. So in here, you know, this will be a high probability fair value gap if it trades back down into it in the future. If we see a quadrant and it's laying like that, this is not a high probability fair value gap. Can it be used? Yeah, it can. I'm not going to use that one myself. Okay. If this quadrant looks like that, that is not a high probability fair value gap by my terms. So it's not a smart money fair value gap. It's just the common gap. Common gaps, they can stay open and they can fill in. There's 50-50. I'm teaching you my language to determine that if the quadrant is like that, right on the low of the fair value gap, that's a high probability fair value gap. If it lays just on the high only, like that, that's a high probability fair value gap. Why? Because the candlestick that creates the fair value gap in and of itself, that range, is laying over top of and crisscrossing like a crosshair on the sniper rifle. That is where you're aiming. You see that? Big light bulb moment. Okay. So anytime someone tells you oh yeah, he has all these fucking lines on a chart, when it's going to hit something eventually. Yeah, it's going to hit one that gives you the theory that I'm teaching you. And then when it matches, and it matches during a time window, open, okay? If it's in the first 30 minutes of the opening range in index futures, and it lays on top of a quadrant like that, man, that's high probability, huge probability. If this happens to be the first presented fair value gap, and it's laying over top of a quadrant of the opening range gap, new day opening gap, new week opening gap, um, previous day or close proximity candlestick premium wick or discount wick, and I taught you how to find them. Looking at the daily chart over here, see, I'm already teaching more shit. This is what happens. When I do pre-recorded stuff, I have a very specific set of information I want to cover, and I get done. I don't go on and on and on. But I'm like a fucking encyclopedia, a fire hose that just can't shut off. And I know you love it, but I'm never going to get what I want to get done now. But this wick here is the highest one of all these. So you want to grade that one and carry it forward and watch how price is utilizing it. And I'll show you what I mean. And I promise this is the last thing I'm going to talk about. I have to get off here. If you liked what you've learned so far today and you appreciate the time and energy and effort I'm trying to put into you, proving this stuff is working scientifically. It's not bullshit. It's not guesswork, folks. Okay, I don't cherry pick anything. I'm waiting for my shit to line up on time. And when it does, then you get to see the results of it. And nobody else can replicate that. At least for right now. Nobody else is this profitable, this perfect, this precise. They're not. But I have students that are doing exceptionally well. And lessons like we've done this past month is going to help them go into the upper echelon of wildly precise and profitable. All right, so we have this Thursday of this past week. Here's the opening on that daily candle into the high. And I'm going to change this to purple because I like Prince and Purple Rain's one of my favorite songs by him. So we're going to dedicate this wick. Shut up, old man. There you go. And are they already showing up? No, I got to carry them over. All right. So we have the low, which is the open of that candlestick on Thursday, comes in at 24,937. All right. 24,000. That's right here. All right. And I'm going to take the opening range line off here because it's already got too many things on it. So these are your quadrant levels. Lowest one in here. No gap. That was immediate rebalance. And here we have fair value gap there. And what time is it? 2:20. Is that the right time? Is that a time that I teach you to use? I know there's a lot of people out there teaching all kinds of weird shit, but that's not what I teach. So that is not the right time. That fair value gap, you would carry it forward. Excuse me. All right. So here is macro time 250. We're inside of it now. Okay. The bodies are respecting it now, isn't it? Do you see what's happening now? Over here, it can color outside the lines with the body, but now it's time. Excuse me, it's time. We're in the 250 to 310 macro right there. Okay. The next candle is laying right on the low end of it. It opens and closes at the next candle right at the low. Let me zoom in because I don't want to look like I'm trying to hide something from you. Not that you can't pull this shit on your chart. Okay. Big paradigm shifts. Ready? 250 starts right there. Right there. Quadrant level tells you that that's the price, but that's not the time. They have to agree. Entries must occur on time and price. This order block, I'm sorry, not order block, it's fair value gap, is laying on top of that previous wick. Okay, and it's trading at the hell am I looking at? Yeah, okay, it's the 24,997.75 level. That's this one here on Thursday's wick. Creates the fair value gap on that quadrant. That's the one you annotate and keep going forward with it. Keep extending it to the right until you get to a macro time, and that is 250 rather. Starts the macro time from 250 to 310. Does the candlestick start respecting that fair value gap? The bodies are staying inside of it. This is permissible. and the body comes back and closes inside the fair value gap. Opens, trades down to the low, just one tick outside of the range over here by the fair value gap. But notice what the bodies are doing. It's respecting it now. And all the way up to 310 there. It's used it there as well. See that? That's what I'm talking about, having the quadrant levels and then determining what what PD arrays, and you can do this with order blocks too. It's not just a fair value gap phenomenon. I'm only showing you the fair value gap because it's visually pleasing and aesthetic. It's easy for you to see it. It just jumps off of the chart versus all the down close candles or all the up close candles. It's a whole lot more to choose from when you ring in the order block. So that's the reason why I chose to start with this idea of the structure behind the premise of why the PD array matrix even works is by having these quadrants on your chart and then looking at these things and then saying, okay, I now have a fair value gap that's valid by price, but I can't do anything with it until it's time to trade with it. So that means from the 250 to 10, I'm sorry, 310, right there. I know, this is fucking genius, isn't it? I tell you, I'm not taking any credit for this because if it wasn't for the Lord showing me this, nobody knows this stuff. I'm telling you, nobody does. Because if they did, they would all came out here and said, "Listen, chump, this is what's really going on. You don't know this, this, this." They can't do it. I begged for it for 15 years, man, and they just won't do it because they don't. They can't. They can't do it. So this means here is your macro time. So in between the start of it here and the end of it there. Okay. You have a chance to be a scalper. Okay. What time of day is this? It's the last hour trading the PM session of the New York market. Okay. So that is a scalping environment. It is not a shit and go, boom, out the door and this blast off and create all time highs. It's not a big wild run of a type of day. It's limited. So you have to pick your shot, know what it's reaching for. Okay. So if you want to be a very simple surgical striking type of a trader, you use the 250 to 310 macro, find a quadrant. If you have an order block or a fair value gap laying on top of it like that, or a suspension block, something to that effect, you now have your price. Keep carrying it forward until you get to the macro time. Then, when that happens, you have to look over to the left side of what price has left you in its wake. When it got down to this level again, what has left in price actions to the left side of the chart? Relative equal highs. Now, is this a high probability candidate for a run on liquidity? That low is lower than that high. That's a valid ICT candidate for a run on liquidity. That's candy land. That's what we used to call it on baby pips. It's like taking candy from a baby. So you can buy the low in here. Every time I tap that low, you can buy it there. You can do the quadrants on that fair value gap in and of itself. It's too I cannot believe I'm putting this on fucking YouTube. I'm a fucking crazy ass. I love you, ICT. Don't go away. So here's the low of it. And then look at the bodies. Look how it's respecting that lower quadrant. I mean, really, look at that. Look at that. Look at the bodies right there, laying on that. It drops and touches the quadrant there. But there's no fucking algorithm, right? That's all buying and selling pressure. All these assholes all around the world are literally saying, listen, we're only interested at that price because, I don't know, RSI said so. Bollinger Bands said so. Pitchforks and Andrews bullshit. Wyckoff something. I'm sure Wyckoff has something that we can attribute to. It doesn't really. But the bottom line is it runs up, and now look at the bodies respecting the what? Consequent encroachment, the midpoint. Look at it. Look at that. Then it rallies up, trades outside of it, and comes right back down into the upper quadrant. And we want to see it now treat this range because it left it. What's the expectation now? Do we want to see it trade down into consequent encroachment and trade in the lower half after it leaves it like that? No, we do not. No, we don't. It can come down in the upper half. Worst case scenario, it touches consequent encroachment, but it needs to do so on a wicking basis, but preferably not at all. Upper quadrant, the bodies are hinting, look, it stays off of it. See that? The next one here rallies up, comes right back down, comes to the high end, doesn't touch the upper quadrant, and look at the body. It's not touching the high of it. That's a signal. That's a little artifact that the algorithm leaves behind for smart money to identify. They do not have level two fucking charts. They are not looking at footprint charts. They have no fucking respect of none of that stuff because it is not doing anything. You can't find the things I'm telling you. These signatures are not found in footprint. They're not found in volume analysis. It's not found on level two bullshit. It's not found in anything else. Open, high, low, and close on a time-based fucking chart. That's it. Time inside this window that's marked here. Price is here. You determine both have to agree over top of a quadrant. Is that complicated? Is it complicated? If it's your first time around, if it's your first rodeo here, this is a whole lot of I don't know what the fuck he's talking about, but it sounds great. He sounds like he believes it, so I'll spend some time with it a little while. But for the people that have been around for a little while and they know how to find trades that are based on the stuff I've taught thus far, you now are PhD level. Take a deep breath right now and think about what you have been shown because I'm telling you how I call every fucking candle as it forms. And it should not come down to that one. It should not come up to here. It should do this. It shouldn't do that. It should do this, but it won't do that. Relative equal highs. Last hour, it's only a scalper's market. Run up, take the liquidity out. You have a quadrant here and a quadrant here. If it's the last hour trading, do you want to see it rip and run? No, you're not expecting that. You just want to get a small little piece, surgical strike, like a cookie cutter shark. There's a shark out there in the water that literally is a little bitch that runs around, finds something bigger than itself, runs up against it, slams into it, boom, hits it, and its mouth is a perfect circle. It bites and runs away, and hopefully it runs away, and it lives to do it again. And that's how it eats. You are a cookie cutter shark in the last hour trading. That's all you're doing. This is the shark. This is the whale. This is the other bigger fish out there. All you're doing is running from the logical level of entering to get that liquidity, get that little bite of it. That's it. You're done. You're done. If this was forming in the first 30 minutes of trading, you are not doing that. You can take something off there, make sure you pay yourself, fund the trade, then let it rip. See how you have to use some characteristics and changing of your thought process from one time of the day versus another time of the day. And the reason why it's like this is because if you're looking at the daily range over here on Friday, just for a moment, let me just take all this shit off here. On Friday, you opened here, traded all the way down, and then up here. So you're already in the last portion of the day. The likelihood of this thing careening up to make all-time highs, not likely. It's not likely to get up to Thursday's high either. It's a lot of range to do in 1 hour. So you're looking at the power of three, which is the open, high, low, and close formation, which is open, accumulate, manipulate, distribute. AMD, power three, it's the way the candlestick's formed, its daily range. You're trading in the last portion of the day. That's not when the biggest portion of the move takes place. The biggest portion of the move is between the first 30 minutes of trading at at 10 o'clock in the morning up to 2 o'clock in the afternoon. Don't take my word for it. That's the lion's portion of the daily range every single day. Unless you see a day like 2 Fridays ago where that's a totally different animal. But generally, the distribution of the volume of not volume in the sense that you want to hear me say it, it's the volume of the daily candlestick's body, the range of the body of the candlestick. That's formed between 10 o'clock in the morning and 2 o'clock in the afternoon. And usually anything after 2 o'clock is just the small continuation of what's already been done since the opening bell or overnight if it's been really moving. And I think that's going to do it for today. I gave you a lot of stuff, didn't even charge you as much as I wanted to, but give me a second here. Let me check my Twitter and see if I put anybody to sleep. Was this boring, or did you find anything in value at all today? Let me see here. Let me see. I think I put a lot of you to sleep. I haven't looked how many people have watched the stream. If someone knows, just send me a tweet because I don't want to change screens and look at it yet. I like to look at it after the fact. I get stage fright when I know there's a lot of people watching. You're welcome, Pavan. If I said that right, Pavan or Pavon. Cool, cool, cool. I got 3 people that said they liked it. That's enough for me today. So, do enjoy the rest of your Saturday. Enjoy and relax Sunday. I'm gonna try to do that, and then, we'll be back at it, Lord willing, on Monday, and I'll probably, tickle your Twitter there too. Until I talk to you then, be safe.